Hello and welcome to the Monday Futures Market Outlook for January 21st, 2013. This is Patrick Srezna. For those of you that have not had the opportunity to try out our eminisource.com trading room, complimentary memberships are available on our website. Also, many of the market timing strategies that you see us using throughout the video are available in our newsletter, The Market Timing Strategist. As always, we start off with a chart of the US dollar index futures, and over the last month, we've seen very little commitment from the US dollar to make a move higher or lower. The price action is still relatively weak, and there is room for a further US dollar deterioration down towards the support line. We are not looking for any big move higher on the US dollar just yet, so a return even back down toward the 79 supports below is a possibility. Next year, I want to take a look at the Euro futures. You can see that the Euro dollar has been one of the reasons why the US dollar weakness was so relevant. We had that the Euro break out to this 134 area, just scratching the surface of that 135 overhead resistance, which was the 2012 highs. We do believe there's room for the Euro to spend some time up along these zones, but more could very well put in a short-term high up along this zone. It doesn't mean a reversal is imminent, but look for further rallies up toward 135, but then there will be vulnerability to things like double tops along those overhead resistance levels. Next year, I want to take a look at the 30-year Treasury bond. It's very interesting. We not only came down to a major support where all those lows came in throughout the months of August, September, October around this 145 level, but we're spending a little bit of time consolidating there. This is a very important make it or break it moment. If the bonds have a substantial breakdown here, let's say heading down toward 141 or something like that on the downside, that would certainly fuel the stock market on the short term a little bit higher as these yields push a little bit to the upside. But in the bigger picture, we don't necessarily believe that this has to be a major top in bonds just yet. It'll be interesting to see whether or not the debt ceiling issues will force a bigger move in bonds than normally would occur, but we're going to be watching this support line. Again, any break of this 145 level, there's definitely room for at least 3 to 4 handles lower down toward 141 if that level is broken. Next year, I want to take a look at copper, and copper has been very sideways range bound. A lot of commodities are not motivated at this point, largely because the U.S. dollar is very range bound. But really, at this stage, copper continues to hold up at the top end of the kind of sideways trade range that it's been in. We do believe at some point copper will make a move of significance, but it still hasn't truly shown its hand in that bigger picture. And so we'll be watching this midpoint range and looking whether or not it can break above, let's say, the 370, 375 level, which would indicate a testing of the 390 levels up above. In the same regard, any break or lower without making a higher high, it leaves vulnerability to testing those support lines down around the 345 to 3.25 area down below. Next year, I want to take a look at crude oil, and crude oil's had actually a very interesting run in the last month. We had a very clean reversal and a nice break above the 95 level on the upside. It's very crucial that crude oil was able to hold it. Even if we do have a dip in crude oil, let's say back down toward 94 to 92 on the downside, we want to see the bulls immediately accumulate that. If that can occur, there is room for crude oil to strengthen all the way up to 100 to even 105 on the upside during the next strength push higher. So we are optimistic crude oil for a little bit of further strength, but we want to see during the little pullbacks whether or not the bulls can hold supports and then accumulate during weakness. Next year, I want to take a look at gold futures, and gold is at a very interesting level. That 1650 level was a key Fibonacci retracement, and it's also a completion of a zigzag pattern down during this correction over the last 4 months. This is going to be a very crucial moment for gold. If we can see a solid push above 1700 on the upside, we may have seen a short-term bottom in gold develop and have plenty of room on the upside to be substantially bullish the commodity. But really at this stage we have not seen the break yet. So while I've been trying to be optimistic on the upside of gold, we have not yet got the confirmation to do that a move has begun or is underway. But just like what we saw that bottom and then subsequently the roll up in crude oil, we could see something very similar start to develop in the gold market. Next year, when we take a look at the S&P 500, we had that little fiscal cliff debacle where we saw a very quick dip below 1400 that just didn't stick, and now we find ourselves up at 1480. Our key upside targets for the S&P were 1500 and 1550 on the upside. We are slowly approaching those key upside targets. This is substantially changing our risk-reward proposition. We do not necessarily believe that that a market correction is imminent, but we do believe that the risk-reward proposition of not taking profits into the strength and distributing into the strength up toward 1500, the risk-reward proposition is poor, and taking profits is a prudent exercise at this stage in the market cycle. We do not want to be buyers of new things along the way, and we're going to be watching how this occurs. Now, overall, the next few weeks, we could still see further rallies, so we don't want to be bearish here, but we simply are stating that at this stage, when we were really excited about the market in November and early December, we now are we're sort of at the other end of the spectrum, where we're now approaching some of the levels where we believe there could be highs developed in the upcoming month or two. It brings me to want to look at the key intermarket observations. We are relatively neutral, the U.S. dollar at this point. It's very close to the bottom of its range, and has shown very little conviction. There's no need to have a bias here at this moment. We remain optimistic commodities. We changed this a month ago, and since then, crude oil is nicely rolled up. Gold is holding support lines. Copper is holding up. So we are seeing commodities holding in, and we think that there's room for them still to turn bullish. Now, this is the key one on bonds. Should I have changed it to average? We're going to see whether the support line holds on bonds. We think at some point bonds could bounce, and there could be another rally in bonds later on. But the question is, where will the lows of bonds come in first? We decided to hold off this week on changing the risk-reward proposition on bonds, but we are looking for where we could rotate that from poor to average at minimum. Now, this is a big change on U.S. stocks and global stocks. We have gone from having a good risk-reward proposition to poor. Now, here's the key thing. I don't want our listeners to interpret that we're forecasting a market correction. It is while a market correction could occur, really this is an identification of the fact that we probably have at best maybe 20 to maybe 60, 70 S&P points upside potential for really 100 to 200 S&P points risk. And while the market may continue to proceed in the next month higher, and you'll see your account growing, you're taking an increasingly large amount of risk in continuing to hold the positions for an inevitable correction that will probably likely occur by the end of the first quarter. So we're simply identifying that the risk-reward proposition is poor, and not that there's a market crash imminent. That was your Monday Futures Market Outlook. Thank you for joining me.